Hey everyone, and welcome back to the channel. Today, we're diving deep into something huge that just happened in the Polkadot ecosystem. On March 14th, or Pi Day as the crypto world loves to call it, Polkadot rolled out a massive update that some are calling a supply shock. We're talking about a fundamental change to its tokenomics, specifically, a major slash to DOT's inflation rate. So, what does this mean for D, for the ecosystem, and for you as an investor or a builder? Let's break it down. First, let's get a handle on what exactly happened. Before this update, Polkadot had a pretty unique inflation model. It was designed to incentivize participation in the network, specifically through staking and securing parachain slots. The inflation rate would adjust based on how many people were staking their DOT. The target was to have around 50% of the total DOT supply staked. If it was less, inflation would go up to attract more stakers. If it was more, it would go down. This created a dynamic but sometimes unpredictable system where the annual inflation could hover around 10%. Now, fast forward to Pi Day. The Polkadot community, through its on-chain governance, voted in and executed a proposal known as OpenGov Referendum 314. This wasn't just a minor tweak. It was a complete overhaul. The old inflation model, tied to staking rates, was thrown out. In its place, a new model was implemented that dramatically reduces the amount of new DOT being created. Instead of a floating 10% inflation, the system has now been restructured. The base inflation for validating the network is now fixed at a much lower rate. The rewards that used to go to crowd loan participants for parachain auctions, they're gone. This is a big deal. So, why the change? The original system was created for a specific purpose, bootstrapping the network. When Polkadot was young, it needed a powerful incentive to get people to lock up their DOT, secure the network, and win those coveted parachain slots. The high inflation model served that purpose well. It encouraged early adoption and helped get the ecosystem of interconnected blockchains off the ground. But Polkadot is maturing. It's moving from a bootstrapping phase to a growth and sustainability phase. The ecosystem is now more developed, with a solid set of parachains and a strong community. The argument was that the high inflation was no longer necessary and might even be holding the network back. It was creating constant sell pressure as stakers and crowd loan participants sold their rewards. The new model, championed by key figures like Polkadot founder Gavin Wood, aims to make DOT a more scarce and valuable asset. It's a shift from grow at all costs to sustainable long-term value. This is why we're using the term supply shock. Think about it. A supply shock happens when there's a sudden unexpected change in the supply of a commodity. In this case, the commodity is DOT. Overnight, the rate at which new DOT is created has been cut drastically. The total amount of new DOT entering the market each year is going to be significantly lower than it was before. For example, a large portion of the inflation was previously dedicated to parachain auction rewards. With the shift towards a more flexible core time model, that entire chunk of inflation has been eliminated. This isn't a gradual tapering. It's a sharp, decisive cut. When supply decreases while demand stays the same or increases, basic economics tells you the price tends to go up. This is the core thesis behind why this update is so significant for DOT's potential value. It's essentially a programmatic version of what Bitcoin experiences with its halving, but implemented through governance and aimed at optimizing the network for its next stage of evolution. So, who are the winners and losers here? Well, long-term DOT holders are arguably the biggest winners. If you're holding DOT as a long-term investment, the reduction in inflation is fantastic news. Your holdings are less likely to be diluted by a constant stream of new tokens hitting the market. It makes the asset more scarce and, theoretically, more valuable over time. The network itself also wins. A more stable and predictable monetary policy can attract more serious, long-term investors and builders who are looking for a sustainable ecosystem to build on. On the other side, some participants might feel a bit of a sting. For example, those who are heavily reliant on crowd loan rewards as a source of income will need to adapt. The game has changed. The incentives are shifting away from passive participation in auctions and more towards active use and contribution to the network. Stakers will also see a change. While their DOT becomes more scarce, the absolute percentage yield from staking rewards will likely adjust. However, the real return when you factor in the lower inflation could actually be higher. It's a shift from chasing high nominal yields to focusing on real inflation-adjusted returns and capital appreciation. Now let's talk about the bigger picture. This update isn't happening in a vacuum. It's part of a much larger vision called Polkadot 2.0. The original parachain auction model is being phased out in favor of a more flexible and efficient system for allocating block space, or as Polkadot calls it, core time. Instead of leasing a whole parachain slot for 2 years, projects will be able to buy core time on a monthly basis, or even on demand, like a pay-as-you-go model. This makes it much easier and cheaper for new projects to join the Polkadot ecosystem. You won't need millions of dollars in DOT locked up just to get started. This lowers the barrier to entry significantly. The inflation cut is a key piece of this puzzle. By removing the inflation that supported the old auction model, it paves the way for this new, more agile core time marketplace. It's all interconnected. The goal is to create a more dynamic, accessible, and economically sustainable ecosystem. So, what should you be watching for next? This is just the beginning. The implementation of the agile core time market will be the next major milestone. We'll be watching to see how many new projects take advantage of this lower barrier to entry. Will we see a Cambrian explosion of new applications and services on Polkadot? That's the hope. We also need to monitor the on-chain data. How does the staking rate react over time? What does the demand for core time look like? How does the overall economic activity on the network change? These are the metrics that will tell us if this bold experiment is working. This move shows the power of Polkadot's on-chain governance. A change this fundamental was proposed, debated, and implemented by the community itself without a hard fork. It's a testament to the flexibility and adaptability of the network's design. In conclusion, Polkadot's Pi Day update is far more than just a small parameter change. It's a fundamental pivot in the network's economic strategy. By slashing inflation and moving away from the old parachain auction model, Polkadot is positioning DOT as a more scarce, sound asset and paving the way for the more flexible and accessible Polkadot 2.0 vision. It's a bold move that creates a supply shock, aiming to reward long-term holders and attract a new wave of builders to the ecosystem. The era of bootstrapping is over, and the era of sustainable growth has begun. It is going to be incredibly exciting to watch how this plays out for the entire WEB3 space. What are your thoughts on this? Do you think this supply shock will have a major impact on DOT's price and adoption? Let me know down in the comments. And if you found this breakdown helpful, don't forget to hit that like button and subscribe for more deep dives into the world of crypto. Thanks for watching, and I'll see you in the next one.